Hello, good day, and welcome to Sundaram Mutual's question hour number 7 on the economy, markets, and investments. This follows through on a webinar earlier this month. We did focus on the various aspects of the economy and markets, and with a special focus on sectors. So we've received a whole lot of questions from interested people already, and as we are going live now, we are happy to take more questions. So let me quickly give you a brief update, since we had done this webinar a bit at the earlier end of the month, on what's the latest development there, right? So just a minute while I get my screen working. Yeah. So the world, as you know, has been through this COVID crisis and now is clearly looking beyond it. And I think that's the important message. A lot of the questions have been around those. So let me explain that the world is now clearly looking beyond the COVID crisis. And that's an important takeaway to keep in mind on the stock markets. What is the reason for this is that we are seeing a very broad-based expansion of the Purchasing Managers Index, which is the best indicator of future GDP growth in the next couple of quarters. So as you are seeing here in this slide, 86% of the economies in the world have seen their headline PMIs expand November over October. So clearly there's a broad-based economic recovery happening, right? The second is that because of this, the IMF actually has revised global growth forecast upwards by 80 basis points to 4.4%, which is, I think, a very, very positive development from what they had earlier expected, right? India is following the same path. We are riding the recovery. In our case, especially in the world, you're seeing pockets where there's a second wave and there's a new strain in Britain and all that being talked about. But in India, we have, I think, achieved a reasonably good success. After peaking in the months of September, we've seen a steady decline in the COVID cases, and as well as the fatality rate has dropped sharply, while the recovery rate has improved around 90%. Right? So, in terms of economy, employment is a key in a labor-rich country like India. Employment is a key indicator, and as you can see from the inverted V-shaped recovery, we have come back to pre-COVID levels, both in rural India and in urban India. Right? Another tracker of this is the GST collections of the government, because as economic activity rebounds, GST collections are a clear indicator of whether economic activity is taking place, which will be reflected in future months GDP growth. I think you can clearly see there's a V-shaped recovery and back at the 1 lakh crore mark. The good news also is that this is not an even spread of recovery on GST. Some states which are growing at 20-22% month on month growth, but there are some which are still in low single digit. So the coming months, as we see these other states also catch up, hopefully GST collection will touch new record highs, and that's good news, right? The other thing in terms of traffic is the electronic toll collection, which indicates passenger traffic, to some extent the heavy vehicle traffic, also showing you a good recovery. Whereas on the heavy vehicle traffic, the freight movement, as you can see, the big commodities like cement, steel, coal, fertilizers, all of them have shown varying rates of growth YOY, clearly indicating that the economy is on the mend. As a result, many indicators, exports, two-wheeler sales, passenger vehicle sales, power demand, rail freight, and GST that we already saw are all showing the V-shaped recovery panning out on the ground, right? Now, when you look at the PMI for India, we had a very sharp fall compared to the world, right? Our services PMI contracted to single-digit numbers and manufacturing to the low 30s, early late 20s. But now the recovery has taken both above 50. As many of you know, the 50 line indicates the changeover from contraction to expansion. And so India has now clearly gone into the expansion mode slowly, right? Those were the manufacturing and the services. The third segment of the economy is the rural economy, which is agriculture driven, whereas you can see the sowing period between June to September saw a steady increase in the area sown, so much so that in the last 7 years, this has been the highest as a percentage of Kharif area sown. Right now, when we come at the overall economic activity levels, you're seeing that Jeffrey's economic activity indicator is standing at 98% of the pre-COVID levels. Now, so as a result, the GDP growth, which is also showing a V-shaped recovery, clearly, while the first quarter showed a 24% negative, the second quarter was expected to show a 9% negative has turned out to be only 7% negative. So the V-shaped recovery is also proving to be faster than expected. And so in the next quarter, we'll still be negative. That's the October, November, December at about 2.5%. But in January, February, March, supported by the post-festival demand sales and the fact that the rural Kharif sowing harvest will come into the market, will give a boost to agricultural GDP. So overall, we expect GDP in the last quarter to turn positive. And the very next quarter, it's showing the high 17% expectation because these numbers are YOY. So the previous year, April, May, June was so bad that naturally comparison to that, you are showing a strong digit growth. But overall, from a next year perspective, FY21-22, we think that we will be back to a positive double-digit GDP growth because 2021 has been a negative year. So I think that's where the economy is rebounding. And now when you turn your attention to the sectors, the RBI's framework of resolution that instead of a third moratorium, they actually asked Mr. Kamath to lead a committee to help the good borrowers get more time to pay and not just a bullet by just extending the moratorium for one more time. See, that has helped something like 66% of rated companies in India. And while this is good news for the banks, because the provisions they needed to make for potential NPAs can now be released for fresh lending, plus the fact is that the recipient industries of this resolution framework, which are the construction, real estate, chemicals, are going to benefit. So first is the RBI has given a kickstart to these sectors. Next is the fact that housing itself has gone through a massive shift in terms of property prices versus incomes versus interest rates, so that the affordability of a house today, if you take it as an EMI to income ratio, from 50% in 2007 has dropped to as low as 29%. And in fact, housing as an investment option as opposed to just a house to stay in. The spread post-tax between a housing loan interest and the rental yield has dropped from 6.9% to 3.1%, making it much more affordable for people to think about buying a second house or a third house. So over the medium term, this is expected to lead to a boom, but bear in mind this boom will play out in three parts. First is there will be an increased sale of second-hand houses by existing people who had bought them and were finding the EMI pinching, would like to get rid of that. So there'll be a high pickup in the second-hand sales. Next will be the excess capacity already built by the housing industry in terms of apartments and complexes. They will start getting used up. Right? So both of these are going to benefit the banks and the housing finance companies who are going to lend into these. But the third and real benefit of the economy comes when all this gets used up and you're getting fresh housing created, which is a multiplier effect. Cement, steel, paint, building material, all of these industries will get a boost. So over the next 3 to 5 years, the housing and the real estate sector looks set for a very secular period of growth. Right. Other than that, India's infrastructure story also in the medium term looks good because we have lots of structural positives. First is we use the crisis to push through a lot of difficult reforms, including the agriculture reforms which are facing the protest today from the farmers. But these are very important, critical reforms which the government has managed to push through. Right. That's important. One. Second is the rating of India also. The way the government has managed the whole crisis in terms of the spend, the fiscal deficit has broadly within the comfort zone of the rating agency. One. Second is because we introduced reforms, the rating agency have a good outlook to India's future, saying that future income of the government will go up and hence our fiscal deficit can come under control. Hence, we have managed the crisis well without a meaningful downgrade. And I expect the coming budget to sustain this thought process, right? So the other thing which government has done over the last couple of years is to drop our tax rates from 35% to a 17%, which is at par with the best in the world today. So I think that's where you will see that FDI will now start coming in into manufacturing in a big way with the lowest ever tax rates. This has been supported by India's infrastructure efforts, where our ease of doing business rankings have shown 79 ranks jump over the last 5 years. And we are also in a supportive framework because China's labor has started a declining phase, whereas India's is still on a rising phase. The red line shows you the decline, the black line shows the increase of India. So for 30 years, India is assured of adequate labor supply for any labor-intensive industry to be set up in India, which is a huge positive from a foreigner's perspective. And China, because of the way they manage the crisis, The world is unhappy about it because they also realize now that concentrating on one country as a manufacturing destination is not good for their long-term interests. It has increased the intention of people who are already manufacturing in China to relocate out, and India has presented its case through what I just said to be the China plus one as a manufacturing country, right? So that's what the poll surveys are showing, that people are definitely wanting to move out of China, and it's up to India to take advantage of those opportunities. So on that basis, when you move to the markets, you can see that in the markets, right? I've shown here data as of a couple of days ago, the 1 month return, 3 month returns, and then the 3 year returns. So as you can clearly see, in the 1 month and the 3 month, you're seeing that whether it's large cap, mid cap, small cap, all have grown similarly. So the rally has become a little broad based in the short term. But if you look at 3 year returns, large caps still outperform. Mid and small caps have still got a negative return on a 3 year basis. So clearly over the last 3 years, we've seen large caps dominate the marketplace, though recently that is changing over to a little more broader market, right? What is the effect of this is that the Nifty actually has delivered a 24% return since the market peak in December 17, whereas both mid and small caps have delivered negative returns of 8% and 30%. Why have large caps delivered such a return? Because from December 17, Indian economy has been in a downturn, further accentuated by the crisis and the lockdown. This is because of the flows from foreign players. So the unprecedented global monetary stimulus, right? You can see that the rates that they have now prevalent are 100 basis points lower than the rates prevalent in the previous financial crisis. So a lot of cheap money is available. The second is that almost $13 trillion of monetary stimulus, quantitative easing has been, note printing has been done by the big countries, and that has leaked and flowed into our country. This is expected to continue. So looking forward to the future, over the next 2 years, up to December 22, another $29 trillion is expected to pump. So this liquidity flow, we believe, will be sustained, right? And the funny thing is that of all the money that's flowing out, it's more largely gone into the developed market. But in the emerging markets, it's still only India which is singularly getting this money. As you can see, compared to Korea, Taiwan, Indonesia, Philippines, and Thailand, it's only India, which whether it is the month to date, week to date, quarter to date, calendar year to date, financial year to date, in all the time periods, India is the single country which has consistently got a portion of this global liquidity into the stock market. What is the reason for this preference on India? We will just come to that. But in the meantime, in rupees crores, from April to now, the bounce back in the market has been driven by the 2,12,000 crore FII buyers, whereas domestic MFs have sold 85,000 crores. Now, why when FIIs are buying domestic MFs are selling? Two reasons. If they have bought 2 lakhs, you can assume that domestic mutual funds have sold pretty much equal to that, to the FIIs. So what they've done is that they have sold to the FIIs, and some money they have put into mid and small cap. That's why you're seeing the mid and small caps also rise. The second aspect is, of course, mutual funds have been fetching less redemptions from investors because those who came in 2016-17 and seeing the market rise have been booking their profits. So it is largely an FII-driven rally, and that's why you saw the returns of the 2 years from December 17 to now 3 years, that it's the large cap which has delivered a 24% return. Now, the reason why the foreigners have preferred to put in India is because this V-shaped recovery that we talked about is showing that from a 480, 70, 80 level that the Nifty EPS has been over the last 3 to 4 years, next year, that is 21, 22, when the GDP growth is going to go to 10%, the income, larger companies' EPSs are expected to shoot up dramatically to 677. This future EPS expectation is being discounted by the FIIs, right? Also, on a relative valuation basis, the top line tells you the India's premium with respect to the emerging markets, and the bottom gives the premium with respect to the world. As you can see, India has consistently been at a premium. Against the world, briefly in March, it went to a discount. But the key is to look at the trend line. Over the last 3 years, India's premium has been constantly correcting. But foreigners always feel that India is a darling child. So this sharp 30-40% correction in the premium meant that India looked cheap relative to other markets, given our growth potential, and that's why the money started flowing back, and you're seeing those valuations rise. So clearly, a correction in our premium was a big trigger for FII money to flow in, right? And the other way is to look at our valuations relative to our past. So this is the MSCI India index, which is a large cap index. As you can see, on the left hand side is the PE ratio, on the right hand side is the price to book. So the important thing to remember is that while price to earnings looks above long-term average, price to book value is actually below long-term average. So this is one of the reasons that FIIs are investing heavily in India. Same story is true of the mid-cap index and to some extent of the small-cap index, right? So overall, right, the Indian indices have correcting between their long-term average on a P/E ratio of slightly rising, slightly above, right? So as a result of this, you're seeing that the PE has actually expanded for the Nifty from 17.8 to almost 20, whereas the mid cap and the small cap are yet at a lower levels than the lifetime high. So today, mid cap and small cap indices are trading at a double-digit discount to the Nifty on forward PE ratio. Right. So the recovery has started at the end. Can you see from March onwards, all the three indices have more or less gone up fairly equally, right? So when you look at the earnings for the second quarter, you can see that the important thing from a sectoral perspective is that the sales, if you see the first two lines here, the sales overall market is down 8%. We know the GDP was down 7.5%, roughly correlates. But the EBITDA and the profit have grown sharply. Why? Because these large companies in the stock market, see, within the overall Indian framework, the whole stock market represents the largest companies in India. They've been able to pass on the cost burden to the smaller companies, to the unorganized sector, and hence they have actually expanded their profitability. And the low interest cost has meant that they have managed to expand even the PAT. But please remember that when you remove banks, the situation looks a little less pretty, right? Because the sales is down double digit and the profits are up only 2%. So what this is telling you is that banks are the main drivers within the stock market of both a top line and a bottom line growth. That's because RBI has helped them with low cost money, with lots of liquidity, and they have not passed on the entire benefit to the borrowing population, and that's it. And this same trend is visible when you split up this into large cap, mid cap, small cap. It is a banking segment which has driven a lot of the profit growth in this quarter, right? And if you look at it, where is they surprised and hence forced the analysts to revise it? It's basically financials, again, exporters, and to some extent global price takers like metals, right? So moving forward to a summary of the stock market performance, we saw the Sensex mid cap, large cap. Now, when you now look at it from a sectoral perspective, the bank index is a very interesting study. 3-year returns of the bank index have been healthy, but 1 year is negative because post the crisis, there's a lot of fear about the NPA crisis in banks and lots of money got pulled out. But you see how sharply that's bounced back. 6 months, that's 40%. The reasons for that, I told you about the Kamath Committee's recommendations and the cheap money from RBI. So banking is clearly on a good wicket, both in earnings and in the overall situation that any growth will have to be financed by the banking system. IT, tech, and pharma are the traditional safety sectors, right? So that's the ones which over a 3-year also have given you good returns, and over a 3 month, 6 months. 1 month, it's slightly come down to single digit. Whereas if you go down and consumption, FMCG is a safer sector, consumer durables is a riskier sector. So as you can see from the 6 months return, it is the consumer durables and the auto, which are the riskier within the consumption, which have gone good returns, whereas your FMCG has given slightly lower in 12%. Similarly, the cyclical, if you see, 3 years, the cyclicals have been beaten badly. But in the 1 month, you can see the cyclicals have started delivering better than your safety. So just a hint that the market is clearly handing over from concentrated large cap rally to a broader mid and small cap, from a concentrated safety rally to a broader riskier rally. I think that's the trend that's happening, which is what will factor in. So if you now look at the weights of the various sectors, because I've shown you the sectors, but how much do they punch? So private banks are 20%. NBFCs are 10%. So 30% of the NSE 500 is banks and financial services. So you have to pay attention to what's happening there, because overall returns of the broader market are significantly influenced by the banking and the financial services space. The next big space is IT with 12.4%. right? So that again is something that will help you to judge the future. And this gives you our fund houses opinions in terms of where we are overweight, underweight. By and large, our portfolio positioning has been fairly consistent over the last 2 months. We haven't changed much in terms of our view. Broadly, it's remained same, except that we have taken up a little bit of a profit booking view in automobiles and pharmaceuticals, given the strong run up in the recent past. Right. So to give you a summary now, before we go on to the questions, right? We believe the pandemic is well behind us. V-shaped recovery is on track. U.S. election uncertainty is gone. There's monetary and fiscal stimulus is expected to continue. Reforms have been big time announced. RBI has continuously supported the government, and agriculture in rural India have remained unaffected by the pandemic, right? And so manufacturing and services activities has picked up. So we expect rural India and the middle income urbanite to remain the segment of strength. And as the economy recovers, the banking system stress buildup will ease up. India has clearly won the battle, winning the battle on the infections, and any vaccine that comes through is only going to help it improve better. And we believe that global QE liquidity is yet to peak, and hence foreign investors will continue to seek better opportunities, and India represents a very, very good business case for investments to come through. So our portfolios are positioned essentially to quality financials, consumer durables, building materials, and auto. Within financials, we're going to be focusing on the large private banks and good quality NBFCs. Recovery in the globe can be played through agrochem, specialty, auto ancillary, and IT services. But overall, IT as a pack is a good balance sheet. And so we would be very, very giving a safety component in IT. And other defenses like FMC, pharma, and telecom will be hardly stock selection picks, right? So overall, what we are going to play is a more close to benchmark sector, but within that, we will take the stock calls to improve. So that's our overall play. So now on that basis, I'll ask my colleague to ask us the questions on this that have already come, plus what you are putting up on chart now.
Yes. So we've got a few questions. The first is, how can one invest in silver?
So the silver is that you think you'll have to use silver ETFs, which are available internationally. And so I think these days a lot of stockbrokers have opened up portals for you to invest internationally. So I think you can look for good silver ETFs to invest in those.
The second, sir, between pharma and infra funds, should we invest in pharma or infra funds now? Time horizon of 2 to 3 years.
So I would try to broaden it. I'll say 18 months to 2 years, pharma looks a reasonably good bet because of all the vaccine development and the good news. But if you're taking a 3 to 5 year perspective, infra would be a better bet. So I would suggest that depending on that time frame, 2 to 3 years is in the middle of the pack. So it's hard to give a call on this. So I would say if it's 2 years and below, pharma looks a good pick, but it's 3 years and above, but really above 3 to 5 years, I think infra is a very good bet to put.
The next question, sir. When will Sundaram Midcap improve?
Good question, because I know it's been underperforming. So I just wanted to tell you what is the reason for the underperformance and when will it improve. So please take a look at this slide. This gives you the sector analysis of our fund as of last month end. Okay, so if you can see here, I would like to point out certain things. So where the fund has underperformed is because in the mid-cap index, finance has been a 15% weight, but our finance is only a 10%. So 4% we have been underweight finance. That has hurt us. Next is if you take the banks, right? Again, they have been 9.4% in the mid cap, but we are only 6.8 because we didn't have confidence in mid cap banks. Large cap was where we felt the banks would do better, as I showed in my slide. The third is in the pharma space, right? 7.4% versus 6. So we are still slightly underweight the pharma, as I expressed from my view, right? Next is the fact is that look at consumer durables. We are at 10%, 8% consumer durables, 10% consumer non-durables. So whereas the index is much lower, 6.9 and 5.2. So clearly, as you can see, we have been very different from our mid-cap index in terms of the weights. These were based on our convictions on Indian economy story. To when the crisis happened, we have done some changes. The earlier position was even more extreme. But in the mid-cap, it's not easy to change over these stocks because these are all stocks which don't carry very great liquidity. Second, our basic confidence remained in the stocks that we bought. So what we believe is that to answer your question, when will Sundaram Midcap improve? We believe that over the next 6 to 9 months, as the story of the Indian economy pans out, you will see that these very sectors that we are overweight on are the ones which are going to deliver the value. So my request is just to be patient for a 6 to 9 month period. As the handover from safety to risk happens, we were confident that our mid-cap fund will also catch up.
Next question, sir. The second wave has begun all over the world, but stocks are yet to fall. Why?
That's because while the second wave is there, the world is much more prepared to handle a second wave because containment. The moment it came in Britain, countries, even India, stopped flights from Britain. We are much more prepared to handle this crisis. We don't underestimate the crisis. One. Second is the vaccine development, right? If you're assuming that the second wave, the current vaccines under development will not solve it, right, is one thing. But I think the world believes that once you have cracked the basic vaccine for COVID, to do a variation of the vaccine to tackle this new variant is also not going to be a challenge and can be done. So I think overall, it's the fact that the second wave can be contained, can be tackled much better, and overall world economic growth is not going to get impacted. And let me remind you that the crisis that we faced post corona was not so much a coronavirus crisis as much as a lockdown crisis. So the world's adopting the lockdown shut off economic activity and hurt the economy and the market. So we believe that they won't resort to a worldwide lockdown. Yes, UK will go into lockdown at specific periods like Christmas, New Year, all of that. But lockdown again for the whole world at large is not an expectation. So I think that's why the markets are saying that while there could be a blip in economic growth in UK or UK dependent countries for some time, it's not necessary that it's going to impact the world at large. And I think that's why the world markets have absorbed this second wave in their stride and are continuing to grow.
The next question, sir. What is the impact of COVID-19 in the aviation industry?
I think it's going to mean a lot of M&A, merger and acquisition. I think there's going to be a heat. Some companies will definitely collapse. All those people who lent money to the aviation industry to buy aircraft, to buy all of that, are going to take a bit of a loss. So it's not going to limit it to the aviation industry, but banks, financial services, leasing companies, those who took exposure to them are going to get hurt. But the world's V-shaped recovery means that travel will bounce back, and hence the remaining survivors, I think, will enjoy a good period. So I think it's a matter of waiting to see who the winners are and then betting on the winners.
The next question, sir, is how is the new strain going to impact stock markets?
I think we just spoke about that, right? You asked that question just now on the new
Yes, sir.
strain. Yeah.
Yes, sir. The next one, sir. Why smart money doesn't love ITC and L&T as much as retail investors do?
I'm not allowed to speak on individual stocks as a mutual fund industry because of the SEBI regulations, right? I think stocks so kindly pardon me. But from a sector perspective, if I can answer you, is the fact that one of these companies, is under regulatory pressure, and it's a FMCG category company, right? Where the market is now moving from safety to risk, and a lot of ESG funds have garnered money, environmental, social. So clearly, the tobacco company is not going to qualify in that. So I think a lot of fund managers are also repositioning portfolios to take into account this, because a lot of institutional investors are becoming more aware socially and are planet aware, and they are saying that if you don't follow these principles, we won't give you so much money. So I think there is a natural flow towards eco positive stocks, and clearly tobacco doesn't feature in that. That's one answer. Now on the other company, on the industrial side, right, on the industrial side, the fund managers believe that in the long run it will come, but all of them already hold a lot of this. So to buy fresh of it at this stage, they'd rather wait and see the V-shaped recovery really pan out. The budget will be a good trigger because infrastructure is a key driver of industrials. And so I think there's a wait and watch approach towards that. So I think I've given you a broader answer, but as I told you, I can't specifically talk about company names.
The next question, sir. Could you please share your views on auto ancillaries given PLI and China plus one?
Yeah, we think we're very positive. So the speed of the pickup there will depend on the speed of global recovery, because substitution capex is one. So somebody is going to shut down a plant in China, come to India. Yes, that's one. But I think it's ultimately the growth, because a lot of plants in China would have got shut down because of the economic crisis. So the world recovery has to happen in a proper good footing, wherein the auto ancillaries is a key thing for India, because we already have the skill set. We already have various automobile clusters in 3 or 4 places in India: Chennai based South, Maharashtra, Haryana, Gurgaon, Punjab, that belt. So there are a lot of places where there are auto clusters, ancillary clusters, which can do well. Definitely, the government support is there through the PLI. So we are medium term bullish, but don't expect an immediate pop up. It will happen over a period of time.
Thank you, sir. In the interest of time, we'll leave responses to the other questions in our comment section and take a few in our next question hour session.
Thank you very much. Thank you for sparing your time for this live questionnaire session. Look forward to meeting you in our EMI webinar in the new year. Wishing you all a very happy new year and a safe COVID-free 2021. All the very best.
Thank you, sir.